This is Richard Flax at MoneyFarm with our regular monthly update. March has been a difficult month for equity markets, with global equities falling around 6%. US trade policy was very much the focus of attention, with a constant stream of news on tariffs being introduced, delayed, withdrawn, and introduced again. The final outcome remains unclear. In April, we might have a better idea of where US tariff policies have settled and how their trading partners have reacted. We think there are a few reasons behind this weakness. First, investors view tariffs as a tax, something that will likely impact demand and economic growth. Second, investors typically don't like uncertainty. It might be effective in a negotiation, but it makes them nervous. At the same time, business executives find it difficult to make decisions when they aren't sure what the playing field will look like. The other focus of attention over the past few weeks has been in Germany, where the government looks set to significantly expand its spending on infrastructure and defense. That's partly a response to announcements from the US government that it expects European countries to take on more responsibility for European defense. But it also reflects a desire to use infrastructure spending to reinvigorate the German economy after years of stagnation. It'll take some time to see just how much the government spends and the impact that it has, but this could represent a real shift in the outlook for German growth. The immediate impact, however, has been for German government bond yields to rise, as investors digest the prospect of increased borrowing, albeit from pretty low levels. There's always a lot of data points to choose from, but this month the team has been particularly focused on surveys of consumer inflation in the US. Back in November, according to a survey from the University of Michigan, US consumers expected inflation 12 months from now to be around 2.6%. Getting close to the central bank's target. In March, that figure had jumped to 5%. That's interesting for a few reasons. First, it suggests consumers are also worried about the constant news flow on tariffs. They're expecting to see higher prices in the stores as a result. Second, we haven't really seen these concerns reflected in government bond yields. Two-year yields in the US have generally drifted lower over the past month or so. It's possible that investors believe that any increase in inflation due to tariffs will be short-lived, maybe offset by economic growth. One question we get a lot is around the outlook for the US economy, which has really helped to drive global growth over the past couple of years. Obviously, at the moment, there's a lot of uncertainty, not just on the tariff side, but also in terms of fiscal spending. The US government has run fairly large fiscal deficits over the past few years, and that's helped to support growth. The Trump administration is keen to reduce those deficits. That might be good news for US government debt, which has been steadily rising, but we might also see slower growth as a result. So far, however, the US economy still seems in good shape. The most recent data releases have come in more or less where analysts expected. That said, we do expect to see a slowdown over the coming quarters. Could that lead to a recession? At the moment, we don't think so, but it's something we'll continue to monitor. Thank you for watching and look forward to speaking with you again soon.